Hey, welcome investors to the 40 Finance channel. Today I've got 7 stocks that I'm going to call easy wins. Easy win stocks here for 2021. These are all stocks that have strong fundamentals, strong growth rates in the future. And in my opinion, with all the uncertainty out there, these 7 stocks offer pretty safe 20% plus returns over the next 12 to 14 months. Reminder as always that my stock picks and projections are just my opinion for your entertainment. Please do your own research. However, if you do like a fresh perspective on stock analysis using fundamentals and hard facts, please subscribe to the channel, give this video a like. Thank you very much for your support. All right, we're gonna start with the big dogs first. And first on the board, as you can see, is Amazon. This is a stock that I own. And here's your 1-year chart on Amazon. And we've got our 50-day in purple, our 200-day in orange, and the RSI is down here. And what you see from Amazon, honestly, is just a lot of flat, right? Even this dip down here and the bounce back up. You just have a stock that's pretty much been flat since September. RSI of 50 is really nothing to write home about. And in general, I would just say the interest in Amazon stock right now across the market is a little stale. And so that makes a great opportunity to invest in a company with growing profits. And the thing that really intrigues me right now with Amazon is, while interest from investors is sort of stale, the company is cranking out earnings. And you just take a look at the annual valuation metrics. Forward PE is definitely at perhaps the lowest point we've seen certainly since 2010. So that's forward PE of 53. It's been pretty rare to come across an opportunity like that with Amazon. And even other metrics like PEG ratio close to 1, that's fundamentally solid. Price to sales under 4, not bad at all, especially for arguably a technology play. And what's really cool about Amazon is while interest is stale, the consensus estimates for EPS, you see this little chart here, EPS estimate, plus 30% over the next several years, quite frankly. And consensus revenue estimates, it's just a straight line up, plus 20%, plus 15%, all the way down. So while the stock is at a relatively fair valuation, Amazon's expected growth on both the revenue and earnings side is unbelievable. Taking a look at TipRanks to see what the best performing analysts think. And we have several updates over the past 7, 15, 18 days ago. You got buys across the board, well into the 4,000s for every single analyst. And this is why Amazon is #1 on my easy win stock list. All right, next up we've got Alibaba, ticker symbol BABA. And Alibaba's in an interesting case right now because basically Jack Ma and the Chinese government had been going back and forth on some arguments about privacy, financial data, stuff like that. That conflict and subsequent penalties seem to have reached the finish line. And I think it's now time to go back to Alibaba after you've noticed this huge decline over the past year. 50-day average, going right down the toilet. You still have a low RSI of 42. So this is another one with Alibaba where I would say, investors, perhaps wisely, are not super interested in the stock right now. So you could be getting ahead of the curve. And if you look at forward PE for Alibaba, you're at 22 right now. And that's a little bit lower than you've seen in their peak, which rode about 26 or 25. PEG ratio under 2, very solid. Price to sales around 5. So this is a stock that when you compare it to other technology stocks, for example, you're getting a lot of value for a company that's growing fast. And speaking of growing fast, here's our EPS estimates for Alibaba, similar to Amazon, straight line all the way up. And while this year, March of 2022 fiscal year, the year-over-year growth is projected sort of single digits. We'll see if that is actually going to happen. I would bet that this number goes up quite a bit. But you look out even farther than that, and you're easily in the double digits, bringing that forward PE down even more. So you think about when I say over the next 12 to 14 months for the stocks on this list, March 2022 is less than 1 year away. So once they close this fiscal year, and frankly, looking ahead maybe into Q3 or Q4 of this year, folks are already going to have their eyes on this price here. So I would expect Alibaba price to go up very soon, certainly over the next 90 days. Looking at the revenue estimates, exactly what you want to see from any company that you were thinking about investing in. Year-over-year growth, all plus double digits, including 30% and 20% in the next 2 years. I'm guessing that on the EPS side, maybe that's impacted by the penalty that the Chinese government, it was a pretty hefty fine, billions of dollars. So maybe that's taken off from EPS this year, which is fine because if you're investing for the long term, that's a one-time hit. It's not ideal, but life goes on. And when you've got revenue estimates like this, things look pretty solid for the future. All right, on the TipRanks side of things, pretty fresh updates, all within 18 days ago. Buys across the board. If I had to pick a consensus out of all these numbers, it's certainly in the $300 range. So analysts agree there's a lot of money to be made for Alibaba stock at today's price. All right, next on the board is ServiceNow. And, we see a similar theme here. 50-day moving average dipping below the 200 on a company that has in the past performed quite well. And when we look at the historical valuation metrics, you got a forward PE today of 86. You could argue that that is slightly above what we've seen in years past. But with ServiceNow, we'll see that the future of earnings and revenue looks very strong. PEG ratio under 3, not as good as the first two, but still very solid. And price to sales under 20, again, this looks high. Trailing 12-month metric, that's what you have to keep in mind. So going forward, I expect on both of these that ServiceNow will outperform what the metrics indicate today. All right, looking at the chart for EPS estimates, going in the right direction. 19% growth for this fiscal year, plus 27 for the next 2 years. And you can see how that forward PE drops. So again, at some point, we have to start looking at 2022 for a true forward PE. And that's pretty much where ServiceNow sits today. And on the revenue side, a nice curve going up, exactly what you expect. Fiscal periods, year-over-year growth, 27%, 25%, 24%. These are pretty big numbers, and I'll try to squeeze this in a little bit if it works. The number of analysts on some of these stocks that I'm showing you today, you're way into the double digits. So this is far from one person's opinion, right? So sometimes on small cap stocks, you only get 1 or 2 people who follow them, but these are huge companies, and you can feel pretty good that a lot of research has been done on them. All right, taking a look at TipRanks. It's been a few weeks here, 21 days ago since most analysts have come in, but you do have a strong buy signals from each analyst. It looks like most of these, almost all of these, are at the $600 or more mark. Today's price is about $469. So there you go. You got your easy 20%, in my opinion and in analysts' opinion, over the next 12 months or so. All right, next one on the board is another one that I own. This is Etsy stock. And really with Etsy, what you saw is a company that probably their stock price went ahead of the curve, if you will, reaching as high as 238 or 244 it looks like, and it's kind of come back down to earth, and now you're trending underneath the 200-day moving average, and you can see that nothing special on RSI of 39. So again, this is another company where maybe the interest level on the stock has waned a little bit. On the historical valuations, Etsy's a little bit harder because it's still growing and it hasn't been profitable for a super long time, but forward PE here, 58 versus what you would have saw back in December, which was of course 80s. That's what I mean about getting ahead of itself. But even if you look back in 18 and 17, a company with a growth rate like this is typically going to trade at a higher multiple than some of the average stocks out there. You still got a PEG ratio under 3 though, versus what you've seen at some points in the past. Price to sales at 11x. That's actually not too bad for the digital space, and keep in mind that's a trailing 12-month metric, so likely sales this year will push them under 10, I would say, almost for sure. All right, EPS and earnings estimates. We'll skip right to the chart. This year, growth 12%. Don't forget, this is a 12% on the unbelievable pandemic growth that Etsy saw. Then you start getting back into the plus 22s, and you can see how this forward PE drops dramatically over the next few years. If you hold Etsy long, almost assuredly you're going to make some money from this point. When we take a look at revenue estimates, plus 31%, almost 20%, plus 26, plus 22. You get the picture, and here's our forward price to sales dropping under 10. So there's a lot of reason to be excited about getting into Etsy now and thinking about, you know, maybe a 2 to 3 year hold. All right, on the TipRanks side of things, it's been a while since Etsy's analyst report, so most of these ratings came in a month ago. The most recent was 22 days ago, but you do have all buys, right, coming off of the earnings news, well into the 200s. If we go by the most fresh opinion, you've got 245. You know, I'm saying for this video, easy plus 20%, so we'd add about $32 to this price. That would put you at 204. So right in line with some of these people over here. And bottom line, I think Etsy's an easy 20% gain over the next 12 to 14 months. All right, next on the board is Micron Technology. Here you see a stock that's trading maybe just below its 50-day average, which has been trending down just ever so slightly. Probably one of the higher RSI indicators on this board at 52. But this is one where you have to start thinking about the chip shortage and Micron's track record of success in the past. That's really where my mind goes with this one. Now, on the valuation metrics for Micron, if you're going to look backwards, you're going to see some high numbers like this trailing PE of 29 versus, you know, the chip sector runs relatively low historically on a price to earnings ratio. If we look forward, though, at 826, it's not as good as we saw in 18 and 17, but when chips hit their peak back in 16 and then heading into 2020, Micron is indeed at a very affordable price. PEG ratio well under 1. This 0.38 is not something that you're going to see for very many stocks. Price to sales around 4, that is a trailing metric. You can see typically they should be in the 2s. When we get into the earnings here, you're going to see that the 4.06 will likely be coming down very quickly. All right, let's take a look at the earnings and revenue estimates. A much different chart than we've seen from some of the other ones on this board, and that is because of a pandemic dip and the subsequent rebound. And I think what's not represented in here is just the fact of the chip shortage and where we think Micron can go. So when you scroll down and we look at year-over-year growth, Micron, almost 100% growth year over year. Some of that is pandemic related, obviously. But even heading into August of 2022, you've got 100% gain. And then after that, this is important for this stock. After that, you start to see analysts concerned about the future, okay? Because chips are very cyclical. I think everyone agrees that the next couple years for chips are going to be huge just because of the back order. But this could very well be one where you maybe try to get your gain, and in the first part of 2022, you might sell out. Looking at the revenue estimates, a lot of the same stories. So plus 27%, plus 29%. Then you start to get into a cloud of uncertainty on how much demand will be left in the chip sector. But you've got a lot of time, right? August of 2022, well over a year away. So maybe you hold Micron and you try to get your 20% return and then you bail on it. On the TipRanks side of the coin, we have several updates over the past 15 days or so. We got buys across the board. If I had to guess the average, just eyeballing it, I'd say, 36% or so seems about the middle. Again, for this video, we're looking for plus 20% gains. So if you added, roughly $16 to 84, that would give you a price of 100, and that would be the lowest price on the buy board. So my 20% easy win looks well intact with Micron. All right, our next couple stocks are much smaller cap. First one being Cohu Incorporated that makes semiconductor test equipment for manufacturers. So continuing on the semi theme, I believe that Cohu has the opportunity to sell a lot more equipment to semiconductor manufacturers over the next couple years. Pretty much sits firmly within the 200-day and the 50-day. You still got a pretty light RSI of 45, so it's not smoking hot right now, which is a good thing because maybe you can get into this one at a quiet time. And then if Cohu does produce good results, you'll have the opportunity to enjoy plus 20%. All right, historical valuations for this one, very mixed bag because it hasn't always been a profitable company. So we don't really have any forward metrics, PEG metrics. You do have price to sales sitting around 2. That's not necessarily the cheapest you've ever seen for this company. But again, trailing 12 months, right? So we're looking backwards, just like this PE is looking backwards. So the historical valuation, I don't think tells the whole tale here. The real win here, in my opinion, is the earnings estimates going forward. So you can see analysts coming in 313, 350, 378. Those seem like small numbers when you think about Amazon and whatnot, but the growth on them, plus 100%, plus double digits here, put your forward PE in a reasonable range, and that's assuming they don't beat these earnings estimates, which I have sort of come to the conclusion I think they will. When we look at revenue, and here's the full chart of revenue estimates. Now, don't forget, this is a smaller cap stock. So every year outside of here that you go, you probably don't have as many analysts looking at it. So let's stick with December of 21 and 22. Year-over-year growth of 46%, and then another plus 2%. So very similar to Micron here, that this one could be sort of your 1 year hold to get an easy plus 20%, and then you might sell. All right, checking in on TipRanks. I got a few analysts that are a month fresh, and look at some of these prices that you see even 21 days ago. Buy at $55, $77, $65. Let me adjust this timeline here. So you see 1 month ago, 21 days ago. That can be a long time for a stock like Amazon to get the freshest news. But in an industrial test equipment manufacturer, I would say that these are still pretty fresh. All right, last pick on the board today for me is Magnite, and I will say right off the bat that there's less fundamental support for Magnite than any other stock I've covered. However, this is one that I own and have been adding to. You see this huge dip from 61 all the way down to 24, 25 bucks. You could have got it. I've been buying in here, and lucky for me, my cost basis sits just under $35, I believe. You can see the RSI on this one has cooled down considerably. The up pattern, you were in the 80s for most of it, and like so many other high growth names in the stock market, you know, we've lost a little bit of air in the balloon, bringing it back down to earth. So as I mentioned, not a lot of fundamentals to work with here. You do have price to sales. That even by itself is trending higher than anything we've seen over the past several years. So this is a one that you definitely have to be looking forward on revenue and earnings. And my expectation is that they beat what analysts think will happen. All right, so let's look at these Magnite earnings estimates. You did hit a baseline profitability in Q4 of last year, and analysts expect that continuing to grow. And even though these are small numbers, 59 cents, for example, it's quite a build on 17 cents, and certainly taking another step into 83 cents the next year. So from a growth perspective, you know, these are huge percentages on the earnings per share line. On the revenue line, you know, plus 79%, plus 27%. Forward price to sales in both of those cases drop under 10. So I like what Magnite's doing. And if you're bullish on streaming video, for example, that's going to fit right into Magnite's case. I'm definitely bullish on the future of streaming, and so I feel pretty good at putting Magnite on the plus 20% easy win list. All right, taking a peek over at TipRanks, we've got a few analysts that cover this stock with fresh ratings. You've got buy signals, you know, 60, 50, 70, 46. Current price today of $30.13, so 20% of that would add another $6 or $7. So well within range of analysts' expectations, and certainly a better way to grow your money than the traditional savings account. All right, guys, so that's my list of 7 easy win stocks. I think that not just me, but other analysts on the street can easily see plus 20% wins for each of the stocks that are here. So in this era of market uncertainty and which way are we going to go, and inflation, deflation, etc., I feel really good about these names being able to get you a return on your money in even these uncertain times, looking ahead over the next 12 to 14 months. All right, let me know what you think about the stocks on the board here today in the comments. As always, thank you for watching. Please give me a like and subscribe. We'll see you on the next video.